All right. Good morning, everybody. TGIF, huh? Get her done. So the earnings changed everything, went from sideways to popping upward. We're through most of the Mag 7 at this point. The AI dominance continues. Money's still going to flow into the markets. So NASDAQ's up still more than 1.25, and Europe is down more than a quarter. It's interesting, though, that small caps don't have anything to offer at all. You know, we've had that dichotomy lately where the small caps would benefit in the pre-market and then kind of take a back seat. Could be worth keeping an eye on that to see if it's going to go the other way around today, especially since we already made a lot of the move in the overnight, that maybe we see Mag 7 sort of lose the juice and small caps become a little more dominant through the morning. We're not going to get most of the things that we're supposed to get today. You can see a little asterisk next to all of these. Data subject to delay if government shutdown continues. So we're not going to get most of that. At 9:45, we will get the Chicago Business Barometer. And then we've got some Fed speakers chipping their teeth. And anything else that should hit us is likely just going to be a headline out of the White House. We don't see the president having anything scheduled today, but that doesn't mean we can't get some sort of headline from that direction. On spot gamma, the put wall rolled back down to its previous location. There it is. 65.32 cog line all the way down yonder. So it's so far underneath the weekly 10 that even if we did get down there, we would exhaust our flows and we would likely just bounce off of that level for today anyways, right? And of course that would be a pretty extreme move anyways, to go from 69 to 65. We could do it. There's just no reason for us to do it. So, you know, no reason to think that the put wall is even in play at this point. We're tangled up with the 3-period daily moving average. We're running almost like a zipper pattern on it at the moment. If I snapped Linreg, it would be angled higher. But make no mistake, we're not getting anywhere. We had the initial push after the headlines last night, and then we've just been hanging out here, stalled. Yesterday's low is also where the 10-day moving average is. That's going to act a little bit like a magnet since we're this close to it. And it's also the volatility trigger. So if we cut the 10-day, it's very likely we're going to go to the cog line 68.32, overshoot that into 0 gamma. And if we get into 0 gamma, we can get to the 20-period daily moving average. Under that is the 3-week moving average. I didn't have the AM edition founders note, but if you looked at the PM edition, they're still looking to the upside, but they're weighing more heavily the idea that hedges are warranted at this point. I know that, hedging just eats into profits. I get it. You're better off just running, like you're a beta weighted portfolio. Seriously. But, you know, even if you don't, it is a time to be very careful about what you are holding on to. Hedges have not performed very well all year because we just keep grinding higher and higher since April. But these sort of violent pullbacks like we got here, where we went from 68.50 down to 65.50, it's a pretty violent move. Those can help monetize those hedges so you can make a little bit back. Unfortunately, hedges, the way that most of the retail I see using them, they're only going to work if you get some really big, violent sell-off. And this, while it may seem big, doesn't fit the bill. So you got to do you. Try to just find some shorts, right? Not something that has run a long ways and looks like it should go down. That's not a good short. Try to find something that has been consistently heading to the downside and doesn't look like it's done yet. There's plenty of that out there. But trying to short things that have been running into the sun and thinking, well, it's run a long way to the upside, it might make a good short. Yeah, it might, but that's standing in front of a roller coaster, and you're likely just going to get rolled right the hell over. Just try to balance out your longs with some shorts somewhere, some appropriate shorts. Otherwise, we are still sitting in this range from the gap up. We're no longer IX10 because we closed underneath this candle. This is the one that was giving us that IX10 classification, but we closed outside of it. That's done. We're still inside this range though. So this is an island, and we can't call it an island reversal yet because, well, we haven't reversed yet. So it's just an island at this point. We've gapped up and we're putting in a lot of work up here. Eventually we're going to get out of this range and we're going to do something else. But that's the thing, right? We got to do that. And so far we haven't been able to. For the shorts, the target will be this 68.25. That's the gap close that we got to get to. I know a lot of analysts will say as soon as we get inside of this candle, anywhere inside of it, they say that that gap is closed. That's not the way I do business. If we closed here and we opened here, then that's the gap that needs to be filled. I want to get all the way back to where we closed on that day. 68.25, that would be the short target if we start to break down. Otherwise, 7,000 is the upside target. Make no mistake about it, if you're trading in the middle of a range, everybody can be in this range. If you're long, you can get in the range and think you're right. If you're short, you can get in the range and think you're right. But until we leave the range, nobody knows if they're right. The longer we stay in this range, the more we're going to build structure above it and below it. Because if you think about it, and not for the ES, but in general, right? If this is the SPX, the SPY, OEX, whatever it is, if you're long in this, where would your stops be? Down here. If you're short in this, where would your stops be? Up here. And until we break either side and violate those stops, neither side knows that they're wrong. And they're just going to keep piling in. More and more people are going to develop a bias. They're going to pick a side. But we have to get out of this range before we know that which side was right or which side was wrong. When we tried to get out of the range, we rejected on both sides and we came right back in again because of that structure that I was just talking about. So there is liquidity up here and there is liquidity down here. And the longer we stay in this zone, the more we're going to build up liquidity on either side. It's going to act like bumpers or guardrails. And it could last all the way into OPEX. If we can't get out of it soon, it'll just build up more and more. It may take headlines or some sort of catalyst to get us out of this zone. Next week, we've got QRA, so that could certainly do it. But we're stuck and we got to get out of everything. You could use yesterday's high and yesterday's low as the defining characteristic of the range that we need to get out of. And then just target 50s. Above 7,000, we've got 7050. And to the downside, 6850, then get this gap closed, 6800, and then 6750 because we're running 50s, right? 6850 to 6750. We have a market maker move this morning. And looking at it from this perspective, you can really see this tight range that we're in. When I look at something like this, I get to asking the questions, did we get any work done last night? Nope. Not when it looks like that. We didn't. So we have a lot of bottled up enthusiasm that could be unleashed at any point today. And they're worried about something because they're hedging. Now, they're always hedged, right? We know that. They're always hedged. This is additional hedging, and it's pure cost, right? This isn't like retail putting a trade on and then calling it a hedge. It will not make them money. And they're willing to spend this money because there's something that they deem a threat today. Well, we just looked at the economic calendar. I didn't see anything. Whatever they're worried about, it's going to happen in the first part of the day today. So before lunch, very likely it's going to happen before 10 a.m. Otherwise, I don't think they would begin to hedge this early. And it's enough of a threat that they're willing to put money in it, whatever that happens to be. So looking at that, knowing that they're hedging, and then seeing this is everybody sitting out. What are they waiting for? Tariffs are going up. It's possible. It's possible they're hedging because they think tariffs are going to go up. If that announcement comes in, they are well prepared for it, certainly. If tariffs are going to go up, though, why not just, from their perspective, why not just trade into the proposal rather than hedge it? That, to me, would be a better allocation of capital. But they do strange things, right? So I don't know. I won't bother to speculate the why at this point. The main thing to recognize is that they are hedging. We know that for a fact. This isn't my opinion. And we have a hurry up and wait with them sitting out, waiting on the data. They haven't participated in the move yet, simply because there's something coming and they want that news first before they do anything else. Now, these ADR lines can get a little trick, okay? Situations like this are where they sometimes can let us down. We had that big move after hours, and then the ADRs got set. So if we open, at 6 o'clock and they get set, then this is their location. But if we had put them on, say, based on the close rather than on where we opened, those ADRs would be in a different spot. And depending on what platform you use, TradingView, Thinkorswim, one of the others where you can code your own level indicators, it may not appear in the same spot. So just be mindful of where those ADR lines are at and whether or not they are based on the close of the previous day or the Globex open from last night. Either way, one really nice equalizer to all of that, depending on your platform, it removes that dependency, is the SPX at 9:30. No matter what platform you use, the SPX gets the ADR lines at 9:30 every day, always. So it's perfect. It just equalizes all of the inconsistencies of yesterday's close versus Globex and blah, blah, blah. So look for the SPX ADR lines today to eliminate any doubt or confusion about the ADR lines today. Otherwise, both the red lines are inside of yesterday's range and they are both on the table. The reason I bring up the ADRs is because we're up 0.75%. We should already be to an ADR line if we're up 0.75%, right? I mean, you get the logic there, right? If we've moved 0.75% through the overnight, then we should be really close to the ADR half, to the ADR full, excuse me, because it's an 82-point ADR line. So we should have already been there. Or we should be through it and up here somewhere. But we're not, because the lines were applied after we moved 0.75%. Okay. That's just the way it goes, right? No tool is perfect. And when it comes to the ADR, that's what we got to stand for. QRA is the quarterly refunding. Here's the government website for that. You can get their treasury statements and blah, blah, blah. Quarterly refunding announcement. So either way, this is the biggest threat. And you can see that we're trying to begin the process of expanding it or getting out of it. When it finally starts to go, it could be one of these big violent moves for all we know, right? So prepare for a liquidity gap type setup and or just a big violent move. The longer we stay compressed and tightly wound like this, the more likely the move is big when we do get out of it. So that's something to keep in mind. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. Yeah, now we're starting to expand. We've already hit the pivot, so we don't have an MDP. And now that we are starting to expand, we can add the S&R lines. You know, we talked about R1 to S2 yesterday. If you missed it, go back and catch it. We almost made it, didn't we? We just almost made that S2. Isn't that awesome? So today we're making a move to the upside. The levels today are farther away than they were yesterday. That's the way it works. If you have narrow ranges, you have narrow pivots the next day. When you have a big expansion day, you have big pivots the next day. You can see how much wider today's pivot lines are versus yesterday's pivot lines. Still with this upside move, 69.50 is on the table, which is basically yesterday's high. Staying between R1 and S1 makes perfect sense. We don't really have any reason to think it's going to get better or worse than that. Going into the close, just keeping this island that we've got would turn this week into a positive week. The bobbing heads on TV could say that earnings went well from the Mag 7 and the market is, holding the highs and blah, 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 and they could talk it up really nice. If we begin to break down and we get into last week's range, they lose that narrative, and then it doesn't sound so rosy and wonderful. It's a nice classic D-shaped distribution. Even the shallow area isn't all that shallow, and I don't think it would be very helpful at this point. We've put in a really nice distribution, and we don't have any help from anything else at this point. We would need to break back down into last week's range to get anything else done. We can see this high volume node from last Friday. It's under 68.50. So if we did drop down and test yesterday's low, it's likely that we fall through that gap, because there is that gap that what was left behind. There's no footprint there to help us out. And then we could get into that structure underneath it. If 68.32 doesn't hold us up, it gets really shallow again, and we find some structure underneath the 92 cog line. Now, I'm looking to the downside, but really, as we have been, I'm still not bearish. We got a lot of reasons to be cautious, but we don't have any reasons to try to short highs, right? There are some good shorts out there, don't get me wrong. Things that have been trending down and offer an opportunity to hop on and beat them down some more. But I'm not recommending shorting from the highs, because we don't have any signals to short from the highs. And unless we get some sort of flash crash negative headline gotcha statement that drops the market for just a short-term drop, then your short isn't going to work. I'm going to be on mobile through most of the morning. I have to take my wife to a medical procedure. I'm leaving as soon as this stream is done. I will be on mobile, though. If you got questions or something's up, I'm just going to be stuck sitting in a waiting room for a couple hours. Should be back by lunch. 10-day, 30-minute volume profile in TPO. This is an ugly, ugly chart. We got the point of control for both of these way below us. These shallow areas are going to act like speed bumps. But when I see this, it's more like that old Rambo movie where he jumps from the cliff and he smashes every tree branch on the way down. That's what comes to mind here if we start to fall, that it would just be hitting every branch on the way down in the ugly tree, right? And if you're just too young to know Rambo, well, I don't know what to say. I guess it's a Netflix and chill night. You should check it out. No new VPOC. Yesterday's VPOC level got taken out right at the open. So we've crossed that level multiple times. The lower value area may be worth marking out. since it is the last line of defense along this gap up. Now we've cut through that level. We cut through it yesterday, but the textbooks talk about carrying forward the value area high, the value area low, and the point of control. With this really narrow range that we've developed in the overnight, it might not hurt to mark out that level so that if we do go down, 68.70 is on your radar. It's basically this pivot point from earlier yesterday. So either one. And then, of course, like we do every Friday, we've got next week's range. So this range is not set into stone yet. It's going to continue to move all day long today. And after the close, around 4:15 or 4:30, it's going to lock into place and then it won't move anymore. It'll be set just like all these old ones are set. But through the day today, it's going to move up and down and it's going to get wider and it's going to contract. We want to compare what next week's proposal is to what we had currently this week. If it's a really wide range, it shows the market is expecting big moves. And if it's a really narrow range, it shows the market is concerned about some big economic event and that they are expecting we're going to go sideways into that event. FOMC, CPI, non-farm payrolls, those sort of things generally can give us a narrow range because the markets see those as volatility suppressing situations. Next week's range at this point doesn't look much different than the current week's range. And of course, this was an FOMC week. And when we match that to the week before the FOMC week, we could see how this was a wider range and then it got narrower for FOMC. And now we've got the same sort of narrow range for next week projected. It could be QRA, maybe. QRA is a little one of those obscure events that happens 4 times a year where a lot of people, even traders who's been doing this for years, will say, QRA, what's that? I never heard of that. Because it's just one of those plumbing things that you don't hear about too much. And yet it's really important, right? It really is. Just because it's not on one of those calendars that we look at every morning doesn't mean it isn't important. The good thing, though, is we keep talking about it. And in the last 3 years, I've seen more and more posts talk about QRA. So, the more we talk about it and get it into mainstream traders' perspectives, then the more it's going to be shared and talked about, and it won't be so unusual and unknown. We're still within that 1.5 collar that we talk about, 1.5 above and 1.5 below when it comes to how far away from the 10-day we are. Right now, we're less than 1% away from the 10-day. So we're not overbought. We're not overextended. We haven't moved too far too fast, and it doesn't owe us any pullback or any mean reversion. Looking at the weekly, we're still at 3.5%. It's not a bad place. It's a bit extended, but if I put my mouse there and we look left, we've been higher than this before. And most of the time we pop up and then we drop back down above this level. There has been times where we've sustained the pop up and we stayed there a little while, but that's kind of rare and it's going to take a lot of juice to get us above 4% and keep it. Usually we get above that 4%. It's like a one-day wonder, and then we're a bit too stretched on the weekly and we end up giving it back again. The thing is about this indicator, when it shows that we're like 4% away and then we lose it, well, it doesn't necessarily mean that price went back towards the 10. Every day, these moving averages are trying to get closer to price. So if we move 4 and 4.5% away from the 10, all we have to do at that point is just stall out and quit moving. every day price is going to get closer to the 10. The 10's going to move closer to us. We can see that when we look at this for an example. I know there's a lot of stuff on this chart. That is the 10-day and the 20, the 10-day and the 10-week on a 15-minute chart. And so you can see how every day that 10-period daily moving average is trying to chase after price. And every week, that 10-week is trying to chase after price. So even if we just sit still and do nothing, the 10 is going to try to get closer and closer to us. So when we look at this and it shows that we got a long ways away and then we started moving back towards the 10, it doesn't necessarily mean that price went down to the 10. It often means we just went sideways and the 10 came to up. And that's exactly what could happen here. Right? We go sideways and give the 10 time to catch up. All right, China's down. Gold miners are down, and down some, but not enough, is energy and healthcare and finance. Kind of want finance to turn around, get on the other side of that. Looking at what's up this morning, we've got Bitcoin, Mag 7, bots, growth, tech, quantum, chips. We got all the fun stuff, UFO, uranium. So it looks really good. These are the sectors that we would want to see for a rally day. And we've got all the ingredients we need for a rally day. My concern is that we're sitting here in this narrow range chopping in the middle of nowhere. If we've got all of the right sectors and we're doing everything the way that we would expect it to be done, why are we not at the highs of yesterday's range and attempting a breakout? So proceed with caution today, because with these sectors that are already up, we should be pressing the high of yesterday at least that much, and we're not. Other than, okay, we're pressing yesterday's RTH high. Fine, I'll give you that. But it's not yesterday's high. It's just the RTH high. So as usual, every day it's GTFO. Shortcut the box. Use this upper range. This is the box that we have to get out of. I wouldn't use that leg, right? I would just take that leg and apply it to yesterday and ignore it otherwise. Then we have the RTH of yesterday. That's the next box that we have to get out of. Outside of that, we've got all of yesterday. That's the next box we have to get out of. To the downside, it's just 2 boxes. To the upside, it's 3, even though these 2 are really close together. GTFO, always, right? You got to get out of the box before you can do anything else. The 10-day moving average and yesterday's low and 68.50 are all right there. That's 3 levels of support underneath us. And if that breaks, I think we could get to 67.50 today. That would get us really close to getting into that 10-week. Which, by the way, 67.50 isn't even bearish. That wouldn't have broke the bullish trend. How's that for a mind warp, right? We still wouldn't be bearish. This morning, if you're looking for any tell that all of this is beginning to unwind and that we're not going to make any kind of bullish breakout today, look for the Mag 7 to stall out and start giving it back. Look for financials to continue that move to the downside and see if chips start to fade away. You could also seek out some sort of capital rotation, start to see things like staples, and industrials, and things like that come up. But Not getting a rally day doesn't mean we got to see a flight to safety. We could just stall out and not go anywhere. I should be back by lunch either way, right? So we'll be back, analyze the charts and see if it's going to give us something this afternoon or not. Keep your eye on the width of that market maker move. If it continues to widen, then the event hasn't happened yet. Once it begins to shrink, then the event is done and they're unwinding it. Its life only exists for today, so it can't survive past the close. At some point today, it'll tip the scale of time and it'll start to shrink simply because it's running out of time. But it should be gone before I get back. It shouldn't even last that long. Right now, the thing's like an ice cube dropped on the floor. It doesn't have much time left. So what I got for you guys, be careful, be safe. Keep your eye on the clock always. It's one of the best indicators you have is the clock. Have a good weekend. I'll see y'all next week.